Over the past couple of weeks, I've been working closely with a woman who already has what most people are chasing: a reliable six-figure income from a successful family business, a large lump sum distribution maybe once or twice per year, no real financial stress in the traditional sense, but she wasn't necessarily worried about her life per se. She was worried about what happens after her. Because while she benefited from a family trust and a business, her three sons were not written into that structure. And she knew that assuming it'll all just work out is exactly how wealth quietly disappears from one generation to the next. So she asked a better question. She asked, how do I intentionally replace what a family business does without building one myself? So her family had done extremely well. The business distributes meaningful income to the current generation, the one that she's in, and it was built intentionally. But there was a very real boundary to that plan, and her children, again, were not inside of it. They were outside of that particular plan. Not because anyone had failed or not because anyone was being selfish. It's just a simple matter of there isn't unlimited money. And every generation has to decide how far the ripple effect actually goes. She didn't want to rely on hope or assumptions. She wanted structure. She wanted leverage. She wanted certainty. She wanted to build it intentionally for her sons. Now, my client in particular, she's not like this aggressive entrepreneur or anything like that. She wasn't chasing these massive returns by any stretch of the imagination, but she came prepared with written goals and was very clear about what mattered. Like literally, she came to me with goals written on a sheet of paper, sent a picture over to me, literally wrote those goals down. So I love how intentional she was. And what she wanted to do was leave a very meaningful legacy. She wanted to use cash value strategically throughout her lifetime. She wanted to create supplemental retirement income for herself, put excess lump sum of the income she receives from the family business. She wants to put that to work instead of kind of letting it sit idle or end up spending it. She wants to build long-term multi-generational wealth and do so very purposefully, very intentionally along the way. And so the solution became very clear very early on. Right? We're going to have multiple whole life policies. Each is going to have a different job. So it's going to be one larger policy on her and then individual policies on each of her three sons. And so ultimately, she's going to be the owner of all of them. And when she passes away, her death benefit will flow into her family trust for the benefit of her sons. So what she's effectively doing is building a very stable source of liquidity for her children throughout their lifetimes, while also transferring wealth fully tax-free when the time comes with her death benefit. Now, and what's important to note here is that what we ended up with is not necessarily what we started with, and that progression is the most important part of the story. So I want to kind of fill you in on that. So we initially looked at a design with Penn Mutual because from a long-term perspective, Penn Mutual produces pretty strong outcomes. So let me show you what that looked like. So my client in question, what she really wants to do was make a $75,000 front load with the option to contribute up to $75,000 per year moving forward, or at least that's how I understood it initially. And so what I showed her was the $75,000 per year premium policy with a minimum contribution of $20,257, okay? And so from a death benefit standpoint, what we're seeing here is that there's about $1.4 million by the end of that first year. 15 years later, what we're seeing here is about $3.35 million of death benefit that's grown to over the years. And from a cash value perspective, she's put in $1.125 million by this point, and we're looking at $1.5 million, or obviously more than that, by the time we get to year 15. So this here is the exact design that we looked at initially when it comes to the full journey that we went on together. Now, the upside on this particular policy was very clear, right? The strong long-term cash value efficiency and clearly a pretty large projected death benefit as well, especially done so in a very permanent fashion. But the problem here is actually the trade-off, okay? So in order to support that level of front loading that she wanted to add to the policy and still have the option to add that again in the future, this policy required a much higher ongoing premium, as I kind of alluded to earlier. Now that ongoing premium is actually higher than she really wanted to obligate herself to every single year. And so if I just specify this down and I go over to page 10, we can see that the whole life base premium is $10,791. The flexible protection rider, Penn Mutual's name for the term insurance rider, was $9,466. And so that minimum premium, again, is $20,257.26. And again, knowing that she wants to not only get a policy for herself, but also her boys, this was a little bit too high of a minimum obligation for her at this particular point in time. Now, I will say, and she knows this, that she could technically afford it, but that wasn't necessarily the point. A great policy isn't the one that works when everything goes perfectly, right? It's the one that still works even when life changed. So we didn't force it. We didn't try to put a square peg in a round hole. So after that, we then explored another policy design with a different company. This company was Guardian Life. And so the reason we looked at Guardian Life simply revolved around the simple fact that she wanted to still make that front-loaded policy premium. She wanted to take that $75,000 and add that to her policy as a front load. So then she started to describe to me about another video, another one of my colleagues, Justin Gartman, did not too long ago, about how you can have some flexibility within your premiums and really what that looks like, especially if you know that you're going to have some income increases in the next couple of years or so. And so that's what we actually designed here. So what I ended up showing her, again, was that $75,000 front load. And then from here, it's like $6,000 per year. And then I wanted to show her a few relatively random years where she contributes the maximum to the policy when she receives these larger injections of capital from the family business. And so I showed that here in the 4th year. I showed it again in the 6th year. I showed it again in the 10th year. So just 3 different times where that $56,000 is added to the policy. And so one of the things that she liked about that was, again, that sort of flexibility. But the drawback to her was the simple fact that, number one, how the death benefit works here at Guardian Life, internally, the whole life insurance death benefit's increasing while that term insurance death benefit's decreasing, but the total death benefit kind of remains level. So that's not a bad thing. It's not necessarily a good thing per se. It's kind of is what it is. But as she viewed that, she would prefer to have death benefit increasing year to year and not have to worry about a significant drop in death benefit after the 15th year. And so to explain a little bit further, and what I explained to her was, if she would have decided to fund a higher sum for more years, there would be a world where potentially this drop in death benefit wouldn't have happened at all. But she didn't want to leave it to chance. She wanted to know without a shadow of a doubt that she was going to be able to leave more than perhaps $700,000, $800,000, $900,000 to her kids. She wanted to maximize her legacy as best she could. So at this point in our conversations, we had the utmost clarity, right? We knew that Penn Mutual is going to give stronger long-term outcomes. We knew that Guardian provides the greatest level of like flexibility upfront with a lower commitment to ongoing premiums. And so the real question became, which trade-off actually mattered most to her? That's the real question.
Hey, it's Demetrius. Just wanted to pause the video real quick because if you're a high earning professional, an entrepreneur, someone who just wants more control over your money, we offer something called a clarity call. It's a one-on-one conversation where we walk you through how an overfunded whole life insurance policy could help you build safe, liquid, tax advantage foundation for your wealth. There's no pressure, no fluff, no hype, just real clarity on whether this strategy is right for you. So go ahead and click the link in the description or the tag comment below, and we'll walk you through exactly how we can help you. Back to the video.
Now, this led us to explore a third option, also with Penn Mutual, using something called their premium deposit fund. And so I'm not going to spend too much time getting into the nitty gritty about what this was specifically, but effectively it allows you to be able to take a pool of capital. In her case, it would have been $75,000, and that itself would have been used to fund that minimum contribution moving forward for at least 10 years. And so if you want to know the specifics on how the premium deposit fund works to kind of automatically pay a portion of your premiums, or in some cases all of it, go ahead and watch some of the videos that we've did in the past on that. Alden did one of the videos, Austin did another one of those videos about the premium deposit fund, and they did an incredible job deep diving on that. So I won't spend the time to do that here. So anyways, after walking through that particular scenario very carefully, including some follow-up emails, recorded videos, kind of phone calls, things of that nature, she came to a really important realization. Right? As we walked through it a little bit more carefully, she realized that using the premium deposit fund would actually kind of cap how much legacy she could ultimately leave to her boys. And that wasn't necessarily the trade-off that she was wanting or willing to make. So what we ended up landing on was a design that was not anchored in front loads at all. But what we anchored it around was what she wanted to commit comfortably every year, no matter what, okay? Because of the fact that she cares deeply about the generational wealth piece, she's not merely looking at it from a cash value perspective. She sees it as life insurance, and the cash value is an additional benefit. And so what she wanted to do was just think through the lens of, okay, what if the minimum premium for her alone was $500, and what if it was $1,000? And so through further conversation, what she leaned toward was saying, hey, I'm very, very comfortable $1,000 a month, $12,000 a year being my minimum premium. And that's ultimately what we're seeing here on this particular policy. Now, what you're seeing here and what she understood is that $30,000 isn't necessarily her maximum. That just so happens to be what we're illustrating. What her maximum actually is a little bit over $48,000. And that minimum, as we can see, if we go down to page 10 here, is that $12,000. So every single year moving forward for her policy alone, $12,000 is what will be due. She'll be able to pay that no problem. And throughout the year, she'll have the ability to contribute all the way up to a little bit over $48,000. So more specifically, this number right here, the annual payment limit, $36,464, is the maximum amount of paid up additions on top of the minimum premium that she could add to her policy. And we did a very similar thing with her boys across 3 different policies. So it was a little bit over $1,000 a month or a little bit over $12,000 per year across all 3 of her son's policies as well. And so that's roughly $24,000 per year in obligations that she's extremely comfortable maintaining. And then from there, what we did is, again, we layered in some flexibility. Again, her maximum, $48,000 per year, whereas the maximum for her son's policies each is $25,000 per year. And so when excess lump sums from the family business show up, she can direct them where they matter most, primarily to the boys' policies, kind of building up some cash value, and secondarily for herself, bolstering her cash value in her death benefit. And frankly, this is what she loved the most. She loved that she could maintain a certain level of contribution, a certain level of premium, get the death benefit she was looking for, create generational wealth and death benefit for her sons, while also being able to bolster that, amplify that even more so with future paid up additions, contributions, or premiums along the way. And one of the biggest things that stood out to her that she was able to bring up to me even before I brought it up to her was, assuming perhaps no policy loans or no outstanding loans later in life, each of her sons is projected to have over $11 million in death benefit each once they reach approximately the life expectancy age, right? That's not by accident. That's a very intentional structure. That's replacing what a family business would have otherwise done without her needing to build one. And this is just one iteration of what we mean when we say the and asset, right? It's not about growth or protection. It's not about cash flow or legacy, but it's about intentional financial tools that do multiple jobs, whole life insurance in this case. And it was able to do so predictably, efficiently, and again, across generations. And so if you're sitting on excess capital and you're wondering how to turn it into something that outlives you, I'd encourage you to go ahead and just schedule a call with our team here at Better Wealth. And we'll walk you through what an intentional structure could look like for you and your family. Thanks for watching. See you in the next one.